Hi, welcome back. This is Brian James Decker here for your weekly market update. Today, I want to talk to you about bonds and the bond market. Right now, we have the 10-year Treasury at 1%. Last August, interest rates got as low as 0.47 on the interest rate for the 10-year Treasury, and the spreads, which is the difference between high yield junk and the Treasury. The spreads, the difference between a junk bond and a treasury bond are the narrowest they've ever been, and it's starting to make the news. That means that, let me say, have in your mind a company, XYZ, where they're not really doing well. COVID hurt them. Whether they stay in business a year from now is up in the air. They're a triple C credit. And they may or may not be around in a year. And that bond in 10 years is yielding 2%. You would think that you'd be paying a very high you'd get a high premium on a company who is a junk bond credit, but nowadays you're not. The thirst for yield, the appetite for yield around the world is consuming everything that has any type of return. I'll never forget, in my 36 years of doing this so far, the hunger for yield story that sticks out of my mind. Argentina floated a 100-year bond 2 years ago, and it was 3x oversubscribed. Why is that a big deal? Well, because Argentina, every 18 to 20 years, they default. Who in the world who knows their history would buy an Argentinian 100-year bond? Well, anyone that just can't stand to not own a 7% yield, which is what they floated that bond out. A 100-year Argentinian bond at 7%, they bought it. Another point, the second point, the reason I'm bringing this up is interest rate risk. Usually when the stock markets go down, there's a flight to quality into bonds, usually gold and silver too. This time, with interest rates so low, we may for the first time have a dual loss in stocks and bonds, because bond prices reflect the country's confidence or confidence of other people looking at that country's debt, their ability to pay that back. We have been irresponsible as a country with the debt situation that we have. So our interest rate may start to go up separate from the stock market. And the stock market, whenever the excitement and enthusiasm behind the 1.9 trillion stimulus runs out, may start to go down too. So we will see what happens, but we normally have a negative correlation between stocks and bonds. Information that's coming in now in diversifying through the pie chart, which is something we don't recommend, may have, for the first time, I don't know when this has ever happened, but stocks and bonds may have losses in the same year, double-digit losses. So this is Brian J. Decker, hoping that you do give us a call and check out options for bonds and bond funds that give you a good yield and protect your principal.